Today's topic, 7 easy and legal ways to lower your taxes. By the time this video goes live, you're probably in a very painful spot if you search this video, and you probably just got crushed on your most recent tax return. And you're probably thinking, shoot, how do I fix this going forward? Well, my friend, you are in the right place, because today we tackle 7 easy, relatively easy ways to lower your tax bill. Some of them more simple than others. Maybe one of them requires you to move and uproot your entire family. So maybe that's not as easy, but it is a way to lower your tax bill from top to bottom. So stay tuned. Those 7 are all coming up next. First up, one of my favorite tax topics, the Schedule A, or what we call itemizing your deductions versus the standard deduction. Last time I checked, I believe almost 90% of Americans take the standard deduction. And sure, it's the easy way out. You get some money off your taxes. But for many, especially the larger audience that tunes into us, assuming higher income earners, looking at you, my physicians, but I know we got some dentists, some vets, some lawyers, other high income, some tech nerds in there as well. But itemizing likely is going to give most of you a chance to get an even larger deduction. So for the year 2024, again, future years you're watching this, low Google search, you can find it. Check out the standard deduction limit. Married filing jointly, $29,200, single, $14,600. So to itemize, what does that mean? Well, it means that you got to get above $29,200. What are the easiest ways to do that? Well, I'm glad you asked. Most commonly, here's what you're going to see. Assuming you are a homeowner, your mortgage interest is going to be a large number there. This is your 1098. The next one, which this is a tax topic that does not get enough credit for high income earners, but the SAL, the state and local tax deduction, is capped at $10,000. But as a high income earner, this number is likely much higher than $10,000, possibly significantly higher than $10,000, but you only get $10,000 of it. So for example, let's just say this is all we got. You got $10,000 of SALT. Let's just say your mortgage interest deduction is $19,000. Well, between those two alone, you're still below the standard. So in that example, you're going to take the standard. So how do you get above that? Well, the most common is going to be charity. Charitable deductions. Most people do a horrible job at actually tracking their charitable contributions, but if you can track those properly, it doesn't require much more than an Excel spreadsheet, just listing where the funds have went to and tracking those, you can get close to going over the standard deduction. This is also a really neat place where you can utilize something called a donor advised fund, or what we call a DAF, where you can make a larger contribution into this DAF, this donor advised fund, get the full tax deduction in that given year. There are AGI limits in there, and then divvy it up over future years, right? So if you're used to doing $10,000 per year in charitable giving, but this year you're going to put in $30,000 to the DAF to get you well above that standard deduction, but then still give out your $10,000 per year as usual. Still checks all the boxes, but in that given year, it got you high enough to get above the standard deduction, where maybe if you were just doing that $10,000, it was always keeping you below the standard anyway. So not to say that you give to charity only for that tax deduction, but remember, if you're giving to charity and you're not above that standard deduction, you are technically not getting a tax benefit for that charitable contribution. Just make that clear. That is one that I'm still shocked on how many don't actually really understand how this part of the tax code works. So you're looking here at your itemized deductions versus your standard deduction, but itemized deduction is probably one of the, I don't want to say super easy, requires a little bit of tracking, and you have to have the right circumstances, right? If you don't have a mortgage, you're renting, and you're capped at the SALT, you probably are better off taking the standard deduction unless you have either high medical expenses in a given year or you're making a large charitable contribution. But look through the Schedule A and you'll see kind of everything that adds into that. So number 1, itemized deductions. Next up on the list, pre-tax qualified plans. Now, in full disclosure for this video, I don't know your situation to say, should you be doing everything pre-tax? Does maybe a Roth make sense for you? That's not the purpose of this video. This is easy ways to get your tax bill lower, pre-tax deductions. So if you're not maxing out your 401k or your 403b, or a 457B. Make sure you understand the difference between government and non-government 457B's plans. If you're a business owner and you're not getting your full profit share, if you're not getting maybe a cash balance plan as a business owner or a lot of 1099 income, anything pre-tax in terms of retirement savings is a very easy way to get your tax bill lower, because these are the very precious above the line deductions. So anything you can do to take advantage of pre-tax retirement contributions, that will be lowering your tax bill. That is one of your low-hanging fruit. That is a slam dunk, alley-oop, whatever you want to call it. This is a win here. But number 2, take advantage of anything pre-tax on the qualified plan side. Next up, tax loss harvesting. Tax loss harvesting kind of has a double benefit to it in terms of lowering your tax bill. The most common reason to tax loss harvest is to offset current year gains or even future gains, right? Those can actually carry forward. So tax loss harvesting, and I should even add, if you're not familiar with this term, this would be an opportunity where you have a stock ETF mutual fund that has gone down in value. You want to sell it at a loss to lock in that loss. You're probably thinking, who the heck wants to do that? Well, in an ideal world, you're going to look to find something similar, but not identical, because of something called a wash sale rule that you would move the funds into. So you're really just kind of registering the loss, but then still going into something very similar pretty much immediately, right? So then if that stock mutual fund ETF does go up, you're still getting the gains, but you locked in those losses. That's really tax loss harvesting in a nutshell. But the two benefits are here that it can offset current year gains or future year gains. Or one of my favorite, what I call tax arbitrage, is you can also use up to $3,000 per year to offset your ordinary income. And I call it tax arbitrage because usually you say capital gains is, the popular numbers are 15 and 20%. You add in some things in there, you can get higher than that, but let's just call it the 15 or 20%. And if you're a high income earner, your ordinary income tax rate is likely higher than that, right? So you get a little bit of tax arbitrage in there. Now it's only $3,000, so it's not going to cover the crazy, I was going to add in some crazy trip there, but I couldn't think of a good one. So it's a way to save some money. It's not going to be anything massive, but still a neat little tax arbitrage where you can utilize that $3,000 per year to actually offset your income. So tax loss harvesting, number 3 on the list, but it actually kind of has 2 separate benefits to it. A little bit over here on the capital gain side, but a little bit over here as well on the ordinary income side. Number 4, own a business. And I realize what you're probably starting to say, that doesn't seem easy. Well, when I say own a business, sometimes it's something smaller, right? Just earning some form of 1099 income can really say that you made a business, right? And a lot of our physicians have side gigs where they may have their academic role, which is the bulk of their income, but maybe they have some side gigs. Maybe they're, an expert witness per se. But anywhere you add in that 1099 income, you're a business owner. And as a business owner, it opens up some new deductions in terms of business expenses. If you have a lot of 1099 income or you are truly a business owner, you get in the 199As, which we call the qualified business income deduction, the QBI, which is a 20% deduction on that. There are income limits there, but probably one of the best tax benefits we have out there right now. Other ones that we see that I really like, home office deduction. We get into the vehicles then, we get a new computer, things of that nature where you can offset that business income. So one of the best ways to lower your tax bill is business deductions, whether that's being a true outright business owner or even just adding some type of side gig in there with that 1099 income. But number 4 on the list is that business side of things where you can really open up the playbook in terms of tax planning. Number 5, you probably thought I was joking in the teaser intro there, but number 5 is literally move. That's right. Move to a state with low or no state income taxes. Take the Chubbs, for example. Lived in the great old Northeast. Now where do we live? Tampa, Florida. I don't want to say it was strictly for tax planning, but let's just say I built a lot of tax plans in the financial plans, and there's a reason why we liked Florida. But in all seriousness, I know this is not an easy one, right? But it's something to consider if you have life transit. And sometimes it's as simple as, I was going to use Florida as an example. I know the Pacific Northwest, we have a lot of good examples, but sometimes it's living in a state with low or no income tax. So maybe you still commute into a state that has higher taxes, but that's where you work, but you're in a lower income or no state income tax state. So I know it's not easy, but if you are thinking through some larger life updates, or you're watching this video and you're a physician in training, you're finishing up your residency or your fellowship, and you're trying to think, where the heck do I end up for my attending role? And you have a few options, don't forget about state taxes, because it can be a large swing if you have 0% tax rates compared to a 9% tax rate. And now keep in mind, if you have a state like Florida where we don't have state income tax, other things are more expensive. The states need to produce that revenue somewhere. So just keep that in mind. Usually if you have no state income taxes, something else could be higher. Number 5, which I'd say is probably not our easiest one, but if you're starting to think through those larger life events, move. Look for a state with lower, or even more preferably, no state income taxes. All right, coming down the home stretch here. Number 6 is not gonna save you $1 today in taxes, but you're going to be very happy in the long run that you did this. And that is the Roth IRA. And again, if you're watching this as a high income earner, it's likely the backdoor Roth IRA, but no matter how you're getting the funds into the Roth IRA is extremely valuable because completely tax-free in retirement, assuming that you're following all the rules on qualified withdrawals. But let's just say that you're going to easily check all those boxes. Most importantly, the 5-year rule, you're going to be, and then retirement, 59.5. But if you're checking all those boxes, it's completely tax-free. That is a really powerful tax tool. But you got to start thinking about it today. Right? That's why we always tell our clients, like the backdoor Roth IRA, it's not super sexy today, right? You're in 2024, your limit's $7,000. It's not a huge number, all things considered, like compared to your 401k or even like a taxable account where there's no limit. But if you do that consistently year after year after year, you get some good compounding growth in there. That is a completely tax-free bucket. And I always say, in retirement, if you have $1 million in an IRA, you have $1 million in a Roth IRA. Roth IRA is actually $1 million. That IRA still has to be taxed. So if you have a 30% tax rate, it's really only $700,000. So while this one will not save you anything in taxes today, it is something I want you to think about as you go forward in a way to reduce your future tax bill. So number 6, that Roth IRA, backdoor Roth IRA. Last but not least, investing in a tax efficient manner. I could take this a lot of different routes. It could be as simple as take advantage of all your pre-tax accounts. It could be make sure you're doing your backdoor Roth IRA every year. When I wrote this one down on my 7, I was thinking more of it in terms of tax efficient investing in terms of like a taxable account, right? So you max out your 403b, your 401k every year. You're getting the backdoor Roth IRA completed. Maybe you're getting some money into a 457b plan. And then after that, you're putting money into this taxable account. We want you to still be tax efficient there. And the good news is tax efficiency has become a lot easier these days. With the addition of ETFs compared to mutual funds, ETFs are more tax efficient than a mutual fund. You can also add in municipal bonds. So in your taxable account, if you do want to have some bonds in there, municipal bonds are exempt from federal taxes. If they're from your state, they can also be exempt from state. If they're local, you can get the triple tax whammy there where federal, state, and local are all exempt if that's a local bond. Now, keep in mind, if you buy a muni ETF, municipal bond ETF, you're going to have a huge basket of them. But if you're going out and buy individual mutual funds, that's where you could be that specific down to a local level. But regardless, you want to build in a tax efficient manner because those taxable accounts will send out a 1099 every year. And you're trying to limit the amount of tax hits you're taking because that lowers your overall net gain in the long run. So as you build up your empire, as you build up your foundation, make sure you're also building in a tax efficient manner. You're going to be very thankful you did that not only today, but also every year and many years going forward. So number 7, build everything in a tax efficient manner to the best of your ability. And there you have it. 7 easy-ish ways to legally lower your tax bill. As I said, we were trying to get this one to kind of time up when you're likely getting your final tax items from the previous year. And you're probably thinking, oh my goodness, I paid Uncle Sam a lot of money. How do I pay him less legally next year? And that was really our inspiration for this video. So hopefully you got some good ideas. Really, you can build these out. Now, the tax code does change. While a lot of those are pretty much time tested, you know, I can use, for example, the QBI. That is one that could actually sunset. It could phase out here in the next year or so. So keep an eye on the tax code. Work with a very good accountant, a very good CPA. Work with your financial planner to make sure you're optimizing your tax planning year in, year out, because largest bill you're likely paying every single year, Uncle Sam and the crew. So pay attention to that tax planning. As always, thanks for hanging out with me. So if you have not subscribed, subscribe to the channel. If you click on this bell icon, we'll also give you a notice every time we release one of our now weekly videos. So that's right, we're coming at you weekly now. And as I continue to emphasize, drop us a comment down below, whether it's just a shout out to say hello. We'd love to say hello to you. But also, if you have any questions, if you have any ideas for future videos, let us know. We'd love to get you featured on an upcoming video. Again, thanks for tuning in. I'll catch you on the next video.